Hey folks, it's Wednesday, the 12th of Jan 2022, and we've had a massive update yesterday on oil, so we're going to have a talk about spare capacity, which I think is one of the big overhang risks to the oil industry, which has us elevated here on prices. I think mainly the big driver is that we are coming out of what is a not so scary Omicron situation, and travel is set to come back and snap back a lot faster now that governments are digesting the softer effects of Omicron. But for this session, really, I wanted to look at one of these key elements that needs to be factored in when you are trading oil and looking at the greater, bigger picture of context here. Okay, so what we're going to do is we're just going to jump over to this article here from Reuters. Now it's by Ahmed Gadar. Usually I follow John Kemp, working with Reuters as their energy expert, but really this article, and I will put this link in the YouTube for people to reference. Really, one of the big things here is that we have essentially spare capacity for this year set to fall below 4 million barrels a day, while we have forecast global demand to be at 99.6 million barrels per day of demand, right? So if we kind of do a little bit of maths here on this, you can see that, well, put you out of your misery, we have spare capacity, demand. So to spare capacity, right? We have demand in 22 is set for what do we say, 96, or what do we hold on a sec here? Let me reference this. We have it at 99.6, right? We have we have 96 million barrels per day, right? And if we have spare capacity at for 22 at 4 mil barrels per day, that's around 4%, I think it is. So 4 divided by 96 multiplied by 100 is 4.16 equals. So we can serve, if these producers have to ramp up, spare capacity is at 4.16% of global demand. So what does that mean? That means that if we have an oil price shock, if we have a shut-in, say we've seen Kazakhstan go down recently, last week, Russia sent in the peacekeeping troops to calm things down, production is back online. But that took off about 1.6 million barrels a day of global production, okay? So, that's significant. If you only have spare capacity of 4, right, you can see quite quickly that if there is kind of a risk, like a war risk in the Middle East, if there's storms, if there's an attack on Saudi production facilities, that can really wipe out a lot more than 4%. We had the Houthi attacks in 2019 on the Saudi production facilities, and that took out a significant amount of production capacity for the oil market, right? So one of the big things that the industry is kind of scared of now is that if there is a shock, there is very little latitude for the market to respond to that shock, okay? And so we're currently sitting in and around these figures now in January 2022, with demand now set to come back to actually 100 million barrels a day, while the spare capacity continues to dwindle. Why does the spare capacity continue to dwindle? Well, essentially, what is spare capacity? Spare capacity is the ability for a producing nation to be able to then ramp up. So they are given quotas that they are allowed to produce at under their OPEC regulations, and they try to hit that target of, say, Saudi Arabia has. I actually don't have the figures off the top of my head, but let's say Saudi Arabia has capacity for um, 10 million barrels a day. Let's just say that, right? That if they were flat out pumping, they could produce 10 million a day, but they're actually only producing, say, 7 million a day. So that means that they have a spare capacity of 30% nationally, right? So they can, if they need to, they are a swing producer, and they could ramp up or contract production at will quite easily. But we're in a situation now where, because OPEC is now, because we've had little to no reinvestment in production for the last 2 years because of COVID, we and then these producer nations then do not, they want to ramp down on production because there's supply glut there and storage and whatnot. Right now we're coming out of that situation, and OPEC is now saying, well, we want to add on 400,000 million barrels a day each month going forward. And these OPEC nations are actually struggling now to meet those upper targets of putting oil back on. But as they put that oil back on, they're eating into their existing spare capacity, right? They're and then they have to think, well, to meet this new quota that OPEC wants to put back on supply to keep prices down, we have to put more money in. Well, we're not going to do that because we don't want to reinvest just yet. Some are coming back online. You're seeing production in the US at 11.8 million, up from about 11.2, I think, or 4 at the depths of COVID. So they are coming back in the US. Higher prices help that to happen. But you're seeing a lot of these OPEC nations actually struggling to meet 100% of these targets as the quotas go up and up each month. All right. And so it's that struggle that shows a tightness in the oil market. There is tight capacity to ramp up production. Okay. So this is one of the main factors we have that's driving price up. You're seeing Daniel Jurgen and IHS Marketing or IHS Markets coming out there, I think 2 or 3 nights ago. I think it was 2 nights ago on Monday, saying that the only significant upper resistance for oil is actually $107 on WTI. Now you see a big update yesterday about, I think at the top of it we were up at about 4%. I think we closed about 3.25% up on the session. You know, this is really one of the key factors that's driving it. I mean, you put into that basket, you've got Omicron really being the common cold. I'm reading the Irish government here is now really looking to just treat COVID like the common flu. You're getting a complete dissipation of that risk that you would have seen over the Delta wave, for example. Now, obviously, a new, much more severely impacting COVID variant may come about, and that is one of the big shockers that could whip us right down from currently trading 81.72s on WTI here on the market. But I can't see it, and everything does feel like the risk of COVID is dissipating. Governments are now really sort of easing their way into this living with COVID strategy. So I think it's over. I think the clouds are clearing and it's over. Now, a lot of people are going to say, yeah, well, let's just take that cautiously, Tim. It's certainly not up to me to call it over or not. But from what we're seeing in the markets here, these markets are responding very well to all sorts of shocks at the moment. But of course, the overhang today in capital markets is that we have US CPI year on year set to come out 7%. We haven't seen that, I think, since the 70s. Prior reading 6.8%. So inflation is real. Inflation is not transitory as much as we were led to believe it is. about 12 to 18 months ago. And so let's see what we get today. Certainly a miss on this figure of 7%. If we come in at 6.5 or even in line with the prior 6.8, you're going to see equities really get on for new all-time highs, I think, and the market's just going to lap that up. And indeed, with that, you're going to see increased vigor in the economies, and that is going to maintain the bid for oil. So more upside to come on WTI. Thanks for tuning in. Please do hit the like and subscribe button, and please do join us in the Discord channel where we're doing this stuff every day. All right, have a good one. Cheers.